Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Seagate Technology Holdings plc quarterly report. Seagate Technology Holdings plc offers a wide range of data storage solutions that cater to various industries and applications. At the core of their offerings are mass-capacity storage products, including enterprise nearline hard disk drives, HDDs, and solid-state drives, SSDs, which provide high-capacity storage for large-scale data centers. In addition to these products, Seagate also offers a variety of external storage solutions under different product lines, such as the Seagate UltraTouch, OneTouch, Expansion, and Basics brands. These solutions cater to personal computer users, workstation applications, and notebook drives for traditional notebooks and convertible systems. The company's portfolio also includes legacy applications like mission-critical HDDs and SSDs, which are designed for high-performance computing needs. Furthermore, they offer DVR HDDs for video streaming applications and gaming SSDs for gaming rigs. Seagate's product lineup is complemented by the Live Edge-to-Cloud mass-capacity platform, a modular hardware and software solution that supports enterprises' on-premise and cloud storage infrastructure needs. The company sells its products primarily to original equipment manufacturers, distributors, and retailers, making it a leading provider of data storage solutions globally. The list of businesses and services provided by Seagate Technology Holdings plc includes mass-capacity storage products, HDDs and SSDs, external storage solutions legacy applications, mission-critical HDDs and SSDs, desktop drives for personal computers and workstation applications, notebook drives for traditional notebooks, convertible systems, and external storage applications, DVR HDDs for video streaming applications, gaming SSDs for gaming rigs, Live Edge-to-Cloud mass-capacity platform, modular hardware and software solution. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to skyrocket. The stock price of Seagate Technology Holdings plc has seen a significant surge in the past year, leaving investors and analysts eager to understand the underlying factors driving this trend. One possible reason for this increase is the company's strong financial performance, including robust revenue growth and improved profitability. This could be due to various factors such as increased demand for storage solutions, successful product launches, or effective cost management. Another potential contributor to Seagate's stock price rise is its strategic investments in emerging technologies like artificial intelligence, cloud computing, and data analytics. By expanding its offerings into these areas, the company may be positioning itself for future growth and increasing its appeal to investors seeking exposure to these trends. Additionally, changes in market sentiment or industry trends could also be influencing Seagate's stock price. For instance, a shift towards digital transformation and increased adoption of cloud-based services might be driving up demand for storage solutions, benefiting companies like Seagate that offer such products. Lastly, it is possible that external factors such as mergers and acquisitions, partnerships, or changes in leadership could also be contributing to the company's stock price increase. These events can often lead to a surge in investor interest and confidence, resulting in higher stock prices. In conclusion, the reasons behind Seagate Technology Holdings plc's skyrocketing stock price are likely multifaceted and influenced by a combination of internal and external factors. Further analysis would be required to pinpoint the exact causes, but it is clear that the company's strong financial performance, strategic investments, and adaptability in a rapidly changing market have all played a role in its success. Seagate Technology Holdings plc market capitalization of $96 billion is significantly larger than the average industry peer of roughly $15 billion. This shows that Seagate Technology Holdings plc holds a significant advantage in their industry. Seagate Technology Holdings plc trades at a higher price-to-earnings ratio of 50 times and a higher price-to-book ratio of 209.19 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 106% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline are multifaceted and influenced by various market dynamics. On the growth side, increased demand for high-performance workloads in data centers, adoption of new industry standards, and favorable pricing actions have contributed to revenue expansion. The introduction of new products on a timely basis has also been successful, while the ability to anticipate and respond to technological changes has enabled companies to stay ahead of the competition. Growing adoption of AI applications has further fueled growth, particularly in data center end markets, where sustained demand for high-capacity nearline drives has driven revenue expansion. On the other hand, revenue decline is often attributed to factors such as technological changes, increased competition from alternative storage technologies, and consolidation in the industry, leading to stronger competitors. Price erosion due to customer consolidation and increased leverage has also contributed to revenue decline, while volatility in sales through distribution, channels, and changes in demand from key customers have further impacted growth. Uncertainty in global economic and political conditions has also played a role in revenue decline, as well as competitive pressures resulting in lower prices by competitors. The financial performance of the company has undergone significant changes in recent periods. Net income has experienced a substantial increase, rising by 76% for the 3 months and 78% for the 6 months compared to the previous year. This growth is attributed to various factors, including the issuance of ordinary shares under employee share plans, which added $32 to net income, and share-based compensation, which contributed an additional $74. Profit margins have also seen a notable improvement, with income before income taxes increasing from 15% to 25.1% for the 3 months, and from 14.8% to 24% for the 6 months. The gross margin has risen by 18% in December 2025 quarter, while operating margins have increased by 9%, 7%, and 10% on different dates. However, not all factors have contributed positively to net income. Tax withholding related to vesting of restricted share units decreased net income by $35, and dividends paid to shareholders reduced it by $300. Despite these negative impacts, the overall effect has been a significant increase in both net income and profit margins. The company's financial performance indicates a positive trend in operating cash flow. The data shows that as of January 2, 2026, the net cash provided by operating activities was $1,255 million. This is further supported by the 6-month period ending on the same date, where cash provided by operating activities reached $1.3 billion. Moreover, the company's management has expressed confidence in its ability to fund operations and meet cash requirements for at least the next 12 months with its current operating cash flow. These indicators collectively suggest that the company is generating sufficient positive operating cash flow. The company's debt level has undergone significant changes over the past few years. Initially, long-term debt decreased from $4,995 million to $3,501 million, but this decrease was offset by a substantial increase in the current portion of long-term debt. However, subsequent reports indicate that the overall debt level has increased, with figures rising from $4,529 million to $5,027 million, and then further to $7,058 million. The trend is consistent across different time periods, suggesting that the company's debt level has generally increased over time. This increase in debt is likely a contributing factor to the significant rise in interest expenses. Interest expenses have grown by as much as plus $85 million between certain periods, with inflation and elevated interest rates being cited as primary drivers of this increase. The conflicting information regarding the change in debt level highlights the complexity of financial reporting. However, it is clear that both the company's debt level and interest expenses have undergone significant changes over the past few years. The performance of various segments and regions in the market has been a mixed bag. On the negative side, Europe has struggled with lower sales during summer months, while countries with restrictive regulations on cash and foreign exchange movement have also seen poor results. Additionally, areas with high shipping and transportation costs have faced significant challenges. On the other hand, some regions have fared better than others. The United States stands out as a strong performer, thanks to its relatively low shipping and transportation costs. This has contributed to higher sales and revenue in this region. Overall, while there are certainly areas that need improvement, the U.S. market appears to be bucking the trend of poor performance seen elsewhere. Management's outlook for the company is optimistic, driven by growing demand for data and its increased value. They expect to benefit from this trend, particularly as AI applications continue to proliferate. The strong demand environment in the data center end markets is expected to persist. In terms of funding, management believes that their cash resources will be sufficient to support operations for the next 12 months. However, they anticipate higher capital expenditures in FY 2026 compared to FY 2025, but still within a target range of 4–6% of revenue. To meet customer demands, management must continue developing improved products with increased storage capacity, security, energy efficiency, performance, and reliability. They are also focused on executing acquisitions and integrations successfully, managing costs and expenses associated with transactions, and maintaining effective tax rates. However, management is aware of the potential risks facing the company, including volatile demand due to changes in customer spending habits and global economic conditions. Seasonality in sales will continue, and macroeconomic changes may affect business performance. Management is also concerned about the negative impact of emerging technologies on demand for products and potential changes in product prices. To mitigate these risks, management is focused on increasing flexibility and scalability, improving competitiveness, and controlling expenses. They are also prepared to cancel purchase commitments with suppliers if revenues fall or customer demand decreases, which may have a material impact on gross margin and operating margin. The company has made several significant transactions in recent times. In terms of acquisitions, the most notable one is the purchase of property, equipment, and leasehold improvements for $221 million. On the other hand, there have been several divestitures as well. The company has partially retired its 2028 notes worth $500 million, paid $221 million towards capital expenditures, and settled taxes related to net share settlement of equity awards amounting to $70 million. Additionally, it sold its system-on-chip operations in fiscal year 2024 for a mere $15 million. The company has also been involved in some settlements. One notable example is the BIS settlement, where Seagate agreed to pay $300 million to the U.S. Department of Commerce's Bureau of Industry and Security, BIS, over a period of 5 years, starting from October 31, 2023. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts to its shareholders over the years. For instance, in 2024, it paid $307 million in dividends, while also paying $154 million in another year. This trend continued into 2026, where it paid $307 million in dividends for the 6 months ended January 2. In addition to dividend payments, the company has also been actively buying back its shares. In 2024, it repurchased ordinary shares worth $29 million as part of a larger debt redemption program that totaled $500 million. This share buyback activity continued into other years, with $29 million being used for repurchases in one instance. Overall, the company's commitment to returning value to its shareholders through both dividends and share buybacks is evident from these summaries. There are significant concerns about inventory buildup and supply chain disruption. The company's inventory levels have increased substantially, with raw materials and components rising from $257 million to $374 million. This is further exacerbated by unconditional purchase obligations of approximately $1.4 billion as of January 2, 2026. The company also faces challenges in its supply chain, including potential disruptions due to supplier financing arrangements, macro headwinds, and customer inventory adjustments. Shortages or delays in critical components, equipment, or raw materials are a concern, as is the reliance on single-source suppliers that increases vulnerability to price increases, trade restrictions, and regional disruptions. Furthermore, the company's operations may be impacted by reduced demand for its products due to adoption of alternative storage technologies, consolidation among customers, and uncertain global economic and business conditions. Disruptions in international markets, currency exchange fluctuations, and increased costs may also affect the business. In addition, natural disasters and geopolitical uncertainties could disrupt supply chains and decrease demand for products. Tariffs on imported goods and uncertainty in global trade policy are also potential concerns. Overall, these factors pose significant risks to the company's operations and profitability. That concludes the financial summary for Seagate Technology Holdings plc. Feel free to comment below, and I will be happy to answer them when possible.